Hello everyone, this is Evan from the Trade Risk here on Friday, February 19th with a weekend market recap video. We are first going to analyze the current market environment. We're going to look at some other markets and then get into some sector analysis. This should be a shorter video this week because I just put a full-length one out yesterday on Thursday, so not much has changed, but let's spend time looking at the current state of the market and then a few of those other major markets, and we'll call it a wrap here. So an impressive stand week by the bulls, up almost 3% in the SPY ETF, and you can see we didn't quite close on the highs of the week, but we made some good progress. If we go back to a daily time frame, it was a holiday shortened week. Tuesday we came in and we gapped higher and we took out this important resistance right here, or at least a level that was acting as support that we would expect to be resistance, 187.50. Clearing that level gave us the gateway into this range that we carved out a couple of weeks ago. So since that Tuesday opening that set us into that bullish stance to start this week, we saw strong follow through on Wednesday, a digestion day on Thursday, which was yesterday, and then today closed flat on the day, but the bulls made a nice recovery. So I think to keep things really simple here, we are range bound and we are in a range between 187.50 and the highs from last week right around 194.50. I think that's the range that we're playing in right now. Certainly looking at the past 5 candles here, the past week of action, the bulls certainly have the momentum on their side. Some people are calling it a short squeeze, others a rally. You know, it doesn't really matter what you call this, as long as you've been respecting the price action on the way up. There's bullish tones and there's bearish tones, but on the daily time frame, in the short term, I think you have to be constructive. That's what the market's been telling you. It's been squeezing higher, and it hasn't paid to fight it. If you look here, we're starting to get this bullish alignment, this bullish cross on some of these fast-moving averages. That's constructive. That's not something we had in this last rally. So you're starting to see us at least move sideways enough that these moving averages have caught up and started to support price. Now, it hasn't happened just yet, and arguably price is still vulnerable. The daily time frame, though, again, we have to remain constructive. The way we closed on the highs, I think this sets us up to potentially come out of the gate swinging, the bulls that is, just like they did last week. So something like last week, if we come in, start the week with a gap higher, perhaps taking out or getting close to this 193 level, this is a near-term resistance level. These were the highs from the past 2 days. So if we can get through 193.20, I think you get up here, you at least get another point or two of progress to be made, I think, to re-challenge this level. Now, I think this is going to be an important level. We may overshoot it on this first time around. Again, this is all just sort of speculation, but hypothetically, just putting out a couple of scenarios, we may come out strong, overshoot this level, and then, kind of see what happens, squeeze some of the last non-believers up above 195, and then maybe, roll over or, go from there. Again, it's all speculation, so don't trade off of it. Otherwise, I think if you're bearish or if you're thinking kind of glass half full here, you got to take out today's lows, Friday's lows. I think getting back below 190, getting back below these moving averages, that's what you need to see if you want to start shorting this market aggressively, or if you just want to start thinking about hedging up or whatever your strategy is. I think you need to see some more signs of cracking. We potentially saw some signs of cracking in the morning today, but that weakness was bought up and we closed on the highs. So there really wasn't much to go off of. The VIX continued lower, so on. That we'll get into some of these other asset classes, but I think that's the picture you need to be looking at. Again, 187.50, 194.50. Bulls have the momentum. I would respect that, and I think if you want to cheat, 190 or so would be the very short-term, near-term kind of first signs of cracking that you would want to see if you're bearish. Now, and again, just to speak to notes of time frame here, on the weekly time frame, so this more intermediate time frame, everything is still in bearish alignment. The reason, simply look at these fast moving averages in bearish alignment. They're racing lower. They're pressing down on price. You can see that we're arguably trying to trend lower here. It's still a messy range, so you don't really have clear lower highs just yet and lower lows. You know, this might have been your first lower high. You didn't really get a lower low here. You got maybe a slight undercut. So this is still sort of developing this longer time frame, but still does not favor the bulls at this point. So keep the time frame separate. The longer time frame, we're still struggling. The shorter time frame, constructive, starting to come together. Now, if we look at the IWM, similar comments as I tend to always say, where I spend most of the analysis on the S&P 500. We're range bound here. Again, it's very similar comments. 103, that's the big kind of nut to crack on the upside. This area right in here, right around 101, that's an important area as the market, you know, sort of found resistance here for a couple of weeks ago for a several day period. So again, look at the past 5 candles. That is very constructive. That's strong buying, squeeze, you know, short covering, whatever you want to call it. It still looks constructive here. And look at the fast moving averages starting to curl over. So keep that in mind. The Qs, arguably the most constructive, above $100. That's where it needs to stay. I think that's a very clear line in the sand. Again, you got your target right above here, 104. Those were the highs from January. That's where the bulls need to take it, you know, step up their game and take that level out. Otherwise, you know, I think you're just in a bit of a range here with some bullish momentum on your side in the short term. If we look at some other markets, TLT tried to get going on Friday, couldn't quite do it. Tried to push into almost this 132 area. It did fail, closed slightly green, but slightly pessimistic there. I think it's still very constructive, though. I mean, the formation here, strong uptrend, came back down, tested the 20-period EMA, saw a nice push off that Thursday, yesterday. So I think all things considered, still very constructive. Let's see how this acts next week. Again, weekly time frame. Look where it's stalling out. We had that overshoot last week up here, that kind of blow off top, blow off overshoot, whatever you want to call it. But we are trying to simmer down and base underneath this 132 level. I think that is constructive. So it'd be too aggressive, too early to call some type of major top here in the TLT. I don't think we have enough evidence for that yet. If we look at gold, this had an inside day today, down 0.6%, digesting, had a nice move yesterday, filled this gap down. So again, above all the fast moving averages, still pretty extended. It's pent up. This looks good, still strong, needs more time, tough to chase. All those comments sort of apply there. Silver, everything except, just a little bit less, not as strong, still holding up well above the 8-period EMA. Everything looks constructive here as well. An inside day today on Friday, so let's see how this kicks off the week on Monday. USO, this one tried to sell off. Buyers did step in. It closed red on the day, but still kind of hammering here. You're not seeing the bullish alignment yet here in some of these fast-moving averages. Classic range-bound, messy behavior, I think, is what you're going to expect here. $8 to $9.75, more or less. That's the range that this is going to play in. I think you can juke and jive, gap up, gap down, and just be real messy in here until it really figures out some type of its next directional move. I do expect a lot of chop here in USO, probably get back up here at some point, retest these highs, fail, come back down, move sideways. I think that's what you should be expecting in USO. But again, the bounds here are pretty clear to map out. UNG, this was a strong gap down and bearish kind of breakdown today. In Thursday's video, when we were looking at it here, we said, well, let's see Friday, maybe we get some type of fake out breakdown and we get some big reversal up. Clearly didn't happen. Bears have the upper hand right here. I think you need to respect this downtrend. I know it seems to be long in the tooth, but again, you have no signs that this is going to turn around just yet. So I'd sit tight. If you're short, stick with it. But it's clearly no reason to dip by this just yet. Back above $7, then you have some type of defined risk and false breakdown to sort of work with there. Now, if we look at a couple of the different sectors this week, and this will be the last thing we cover in this video, utilities. Had a nice session, had this nice breakout here on Thursday, gave some back, digested a bit here on Friday. Still looks really constructive. Look at the weekly time frame here. You can see it's been a nice healthy base going back pretty much all of 2015. We emerged from it at the beginning of 2016, effectively all of January. Towards the end of January, we saw this nice breakout. So I think this is healthy. This is consolidating above all the fast moving averages. Still looks good. Target to take out 46 3/4. Industrials did really well this week. Look at the 3.2% upside move here, but it is clearly now above the January highs, so that is constructive. In fact, if we look at it on the yearly time frame, still down 3% on the year, but relatively holding up pretty well. It's above the highs here that a lot of the markets have stalled at, that we made in late January. So that is constructive, above the fast period moving averages. Keep looking for the strength in this sector. I think those are the names that are working. And then finally, semis. Look at it on a weekly basis, 5.6% up week. That's constructive. You can see it's testing and testing the highs here from January, or actually I guess the 1st of February, right around 49 3/4. So right at resistance right now. Let's see, maybe we can key off this market to see if this can blast through early next week, or if it fails, rolls over and maybe just needs a little more time. So that's all I have for this video. I hope that helps. As always, if you like the videos, do subscribe here. Thank you for watching, and I will catch you next time.